Somewhere right now, someone is holding a stack of foreign banknotes in a drawer. They didn't buy them to spend on vacation. They bought them because someone online told them these bills were about to explode in value. Overnight, $1,000 in, $100,000 out. Maybe more. It sounds too good to be true. And two words are usually at the center of that promise: revaluation and redenomination. They sound almost the same. Some marketers even use them interchangeably, sometimes by mistake, sometimes on purpose, but they're not the same thing. One is a real, well-documented economic event. The other is often the bait in a story that has been sold for decades to people who simply wanted a better future for their families. By the end of this video, you'll be able to tell the difference in 10 seconds, and you'll understand exactly why that difference has cost. Real people, real money. Let's start at the beginning. To understand a claim, we first need to understand the words. Revaluation is a real term in economics. It refers to a government or central bank officially raising the value of its currency, usually against another currency like the US dollar. It is the opposite of devaluation, where a currency's official value is lowered. Redenomination is also real. It means changing the scale of a currency, issuing new notes that represent the same overall wealth, just with fewer zeros. Think of it like changing 1 million into one on paper without changing what that money can actually buy. These two ideas get mixed together in online investment communities, most famously around currencies like the Iraqi dinar. For more than 2 decades, a persistent online narrative has circulated that a country's currency, often one that has lost most of its value due to war, sanctions, or economic instability, is secretly about to be revalued to dramatically higher levels, sometimes overnight, sometimes by government insiders, sometimes tied to global financial resets that are never clearly defined. This narrative isn't new, and it isn't fringe in terms of how many people it has reached. Regulators, including the U.S. Securities and Exchange Commission and the Commodity Futures Trading Commission, have repeatedly issued public warnings about currency schemes built around this exact promise. Verify source for specific dates of each warning. So here's the open loop for this chapter. If regulators have been warning about this for over 20 years, why does the story keep coming back? To answer that, we need to understand how currency values actually change in the real world, and how different that is from what gets promised online. Let's separate fact from fiction, one term at a time. Revaluation, the real version. A true revaluation happens under a fixed or managed exchange rate system where a government has direct control over its currencies. Official value. The central bank makes a deliberate policy decision to raise that value, usually in response to strong economic fundamentals, trade surpluses, low inflation, or pressure from trading partners. This is not a mystery. It's not secret. It's usually announced through official central bank channels, and it's driven by measurable economic conditions, not hope, not rumors, not insider information. Redenomination, the real version. Redenomination is a housekeeping move. When a currency has suffered such severe inflation that prices are being written in the millions or billions, a government may issue new notes at a fixed ratio to the old ones. For example, 1 new unit equals 1,000 old units. The key thing to understand: redenomination does not create new wealth. If your money was worth very little before the redenomination, it is still worth very little after, just written with fewer zeros. Zimbabwe is one of the most documented examples of this. Between 2006 and 2009, during a period of extreme hyperinflation, the Reserve Bank of Zimbabwe redenominated its currency 3 separate times. cutting 3 zeros in 2006, 10 more in 2008, and 12 more in 2009. Each time, the currency was simplified on paper. Each time, the underlying inflation problem remained because the redenominations addressed the numbers on the notes, not the economic forces printing more money into existence. That's the core distinction to hold on to. Revaluation is about a currency becoming genuinely more valuable through real economic policy and real economic strength. Redenomination is about making an already existing value easier to count and use. It doesn't add value on its own. Now here's where the online claims get tangled. Promoters of certain currency investment opportunities often describe an event using the language of revaluation, while what's actually being discussed doesn't match how real revaluations occur. No fixed exchange system, no clear policy mechanism, and no verifiable economic conditions that would justify it. That mismatch is where Chapter 4 begins. Here's the uncomfortable truth. Currency values are not decided by hope, by patience, or by how many people are holding onto a currency and waiting. They're shaped by measurable things: a country's inflation rate, its trade balance, its political stability, its foreign currency reserves, and the confidence of international markets. So when a specific currency has been promoted online for years as about to revalue, with no official policy announcement, no clear fixed exchange rate mechanism, and no consistent economic data to support it, that's a significant red flag. Take the case most often discussed in these communities, the Iraqi Dinar. Financial regulators and consumer protection agencies in the United States have stated plainly that there is no credible economic model supporting a sudden, dramatic increase in the dinar's value. The Central Bank of Iraq itself has indicated there are no imminent plans for the kind of sudden revaluation described by online promoters' verified source for the most recent official CBI statement. And here's a detail that matters. The online promise usually isn't about a modest, gradual appreciation, the kind that can genuinely happen to developing economies over time as stability improves. It's about an overnight, dramatic jump, sometimes framed as the currency returning to a value it held decades earlier before wars, sanctions, or currency controls reshaped its economy entirely. That framing skips over something important. A currency's old value existed under completely different economic conditions. A currency doesn't return to an old number just because enough time has passed or enough people are hoping for it. This is the pattern investigators and regulators have pointed to again and again: emotionally compelling stories, vague references to insider knowledge, and urgency to buy now, combined with an absence of the concrete economic evidence that would normally accompany a real currency policy change. None of this means every person discussing these currencies is acting in bad faith. Some genuinely believe the story themselves, often after hearing it from someone they trust. That's part of what makes this pattern so persistent. It doesn't spread through malice alone. It spreads through community, hope, and repetition. But belief isn't evidence. And 2 decades of predictions that haven't materialized is itself a data point worth taking seriously. So if the economics don't support the claim, who benefits from keeping the story alive? This is where it's important to slow down and look at incentives, not intentions. Currencies like this are often sold through informal dealers rather than regulated banks or exchanges. Because there's no standardized public market for these transactions, sellers can set their own markup, sometimes significantly above the currency's actual exchange value. That markup is often collected regardless of whether the currency ever changes in value at all. The transaction itself is the profit, not the promised future event. Beyond direct sales, some promoters build audiences through videos, forums, social media groups, and paid newsletters where the revaluation is coming soon narrative keeps people engaged, subscribed, and sharing content with others. Attention and audience size can themselves become valuable, separate from whether any prediction comes true. In some cases, according to state securities regulators, these opportunities have been structured in ways that resemble multi-level marketing, where individuals earn a commission for bringing in new buyers, creating a financial incentive to recruit rather than simply to inform. And because there is no fixed date attached to the promised event, the story can be extended indefinitely. If the revaluation doesn't happen this year, promoters can simply say it's close, next month, next quarter, tied to the next political development. The lack of a testable deadline is part of what allows the narrative to persist for years, even decades. None of this requires any single person to be malicious. A dealer selling currency at a markup is doing what any business does, pricing based on what the market will pay. A content creator building an audience around a topic people are curious about is doing what most creators do. The pattern becomes concerning specifically when it's combined with unverified promises of guaranteed or near certain profit, which regulators consistently flag as a hallmark of investment fraud, regardless of the specific asset involved. Which brings us to what official regulators have actually said and done about this exact issue. This isn't a fringe concern. It has drawn attention from multiple levels of government over a long period of time. The U.S. Securities and Exchange Commission has publicly stated that foreign currency schemes built around anticipated revaluations do not represent a viable investment opportunity in the way they are often marketed, and has advised investors to be cautious of speculative currency purchases based on revaluation rumors. State-level regulators have echoed this. The Alabama Securities Commission, for example, issued a formal investor alert describing how promoters of these currency schemes often offer the appeal of controlling a large volume of foreign currency for a relatively small upfront cost, paired with predictions of near-certain future value. Increases verify source for exact publication date. The Texas State Securities Board has also published investor guidance addressing this exact currency, noting that these opportunities are frequently promoted by unregistered sellers without the kind of formal disclosure documents that legitimate securities offerings are required to provide. At the federal level, one documented case involved the SEC filing a complaint against an individual who allegedly sold securities tied to currency holdings, promising investors that a foreign government's revaluation was not a matter of if, but when. According to court documents connected to that case, the individual agreed to repay investors as part of a settlement after the SEC alleged the underlying claims about access to funds were false. Verify source for full case citation and outcome. Consumer protection agencies, including state departments of financial institutions, have also warned that some of these currencies can be very difficult, or in some cases impossible, to exchange back into U.S. dollars through legitimate banking channels, meaning that even a currency holder's ability to access any future value is not guaranteed. Organizations like the Better Business Bureau have separately included currency revaluation schemes among their annual lists of common scams, reported by Consumers Verify source for specific year and ranking. Taken together, this isn't one regulator raising one isolated concern. It's a pattern of warnings across different agencies and different points in time, describing the same core issue: promises of currency revaluation that are not supported by verifiable economic policy or official government communication. But behind every regulatory filing is something regulators don't always capture: what this actually feels like for the people involved. It's easy to talk about markups, red flags, and regulatory warnings in the abstract. It's harder, and more important, to sit with what this actually means for real people. In documented cases covered by consumer news investigations, individuals have described buying currency because they were thinking about their children's future, or hoping to pay off debt, or looking for a way to build savings they didn't think they could build through their regular income. Verify source for specific individual accounts. Some of these purchases weren't small, careless decisions. They were made after real research, reading forums, watching videos, talking with friends, or church communities were doing the same thing. That's part of what makes this pattern so human. It often spreads through trust, not deception between strangers. A neighbor tells a neighbor. A relative shares an opportunity with another relative, genuinely believing they're helping, when the promised event doesn't happen. Not in a year, not in 5 years, not in a decade. The financial loss is only part of the impact. There's also the weight of having believed in something, sometimes for a very long time, and having encouraged others to believe in it too. This is not a video meant to mock anyone who has held onto one of these currencies. The instinct behind it, wanting more financial security, wanting a better future, is not naive or foolish. It's deeply human. But understanding why the promise doesn't hold up economically is one way to protect that same instinct from being exploited again in the future, whether by this specific claim or a similar one wearing different words. So if this particular path hasn't led where it promised, what does a more evidence-based path look like? This isn't a video about which specific investments to buy. It's about how to evaluate a claim before money changes hands. Here are the same questions financial regulators consistently recommend asking, regardless of what's being offered. Is this being sold by someone registered with a securities regulator? You can typically check registration status directly through state or federal regulatory websites, not through the seller's own claims. Is there a written prospectus or official disclosure document? Legitimate investment offerings are required to explain the real risks, not just the potential upside. Is there a specific, testable timeline, or does the promised event keep getting pushed further into the future? Is the profit described as guaranteed or certain? Regulators are consistent on this point. No legitimate investment can honestly promise a guaranteed outcome, because all real investments carry risk. And finally, would this opportunity still make sense to you if you remove the urgency? If a seller is pressuring you to act today, that pressure itself is worth paying attention to. None of this requires financial expertise. It requires slowing down, checking sources independently, and treating extraordinary promises with proportionally extraordinary scrutiny. The goal isn't fear. It's a simple habit. Separate the story from the evidence every time money is involved. So, revaluation and redenomination. Two real economic terms. Two very different meanings. One describes a currency genuinely becoming more valuable through documented policy and real economic conditions. The other describes making an existing value easier to count. New zeros, same underlying wealth. And somewhere in between those two honest definitions, a story has been sold for over 20 years, one that borrows the language of real economics to promise something economics doesn't actually support. If you remember one thing from this video, let it be this: the words revaluation and redenomination aren't dangerous on their own. What matters is asking who is using them, what evidence backs the claim, and whether that evidence would hold up under the same scrutiny regulators apply to every other investment. If someone in your life has been part of a currency holding community like this video isn't a reason to judge them. It's a reason to have a calm, evidence-based conversation with them, the same way we've tried to have one with you. If this helped make a confusing topic clearer, consider sharing it with someone who might be navigating a similar decision right now. Thanks for watching, and stay curious, stay careful. Disclaimer: this content is for educational purposes only and is not financial advice.